Hey, today we're learning about Chapter 7, Bank Reconciliation. Okay. Sometimes we refer to it as Bank Recon, because we're lazy to say reconciliation. So what a Bank Recon is us checking our book records against our bank records and making sure that the two numbers equal. So here I've set up a problem for you where your company had a beginning bank balance of $8,000 and a beginning book balance of $5,000. Okay? So, they're not the same. So we need to find out why not. So you did some detective work and you discovered that you have a deposit in transit for $740. So a deposit in transit is someone taking money or on the way to the bank. So if money's on the way to the bank, your books would already know this, but the bank wouldn't know this. Okay? And so this is money that we would need to add to our bank adjustment. EFT sales. So EFT is our electronic funds transfer. So someone wired us money electronically for $500 in sales. So the bank obviously would know this because the money is getting deposited into our account electronically. But our books wouldn't know this. So this we'd want to put on the book side for book adjustments. Interest from the bank. Okay, well, the bank will know that they paid us interest. So when you have like a savings account, sometimes you get 1% interest. Okay, so we got 10 payment of 10 from the bank. So our books won't know this amount. And then EFT again, another electronic. This time, someone isn't giving us money, but we are sending money. So an EFT payment for our electric bill, $200. So sometimes companies set up like automatic payments, monthly payments, withdrawals. Okay. So this one we want to make a book adjustment. Okay. So electronically it already withdrew from our account, but we noticed that we didn't make the book adjustment for that. Okay. Next we have a bank. So the bank is charging us money for having an account with them, which is often very typical if you have a business account. So they're charging us a fee of $570. So this will be another book adjustment. The bank already knows they're charging us the amount. Okay. And then we have an outstanding check. So what that means is that we wrote someone a check, but they haven't taken the check yet to the bank and deposited for payment. So it hasn't cleared the bank yet. So the bank doesn't know. The check might be in the mail, or they just haven't delivered the check yet to the bank for a cash payment. Okay. So this we will want a bank adjustment. So outstanding checks, these will always be bank adjustments. Deposit in transits, these are always bank adjustments. Okay, so these two are always bank. Okay. And then electronic payments, the banks always know about the electronic payments and the electronic deposits. Okay. So these will always be adjustments we need to do on our book side. And then interest that the bank pays us, any money the bank gives us, or any money that the bank takes away from us, okay, so just like our electronic payments, these will always be book adjustments. Okay. So now over here I have a bank reconciliation set up. Okay. So here's my bank side and my book side. So in the problem, it had said that we had a beginning balance already. So we had 8,000 was our beginning for the bank, and 5,000 was our beginning balance for the book. So we need these numbers to balance out at the end to equal. So I'm going to add my deposit in transit, because once that money gets to my bank, it'll make the number bigger, so we plus that amount. Okay. And then I want to minus the outstanding check, because once that person deposits the check that I gave them, it'll take money away from my bank amount. Okay. So I'll have 4,740. My bank adjustments, I will never need to make journal entries for these because we already have the journal entries on our book side. Okay? That's why we're not in balance. That's why our numbers do not equal, because we've made the journal entries on our book side, but the bank hasn't adjusted for them yet. So we make those adjustments. Again, we will not make journal entries for bank adjustments. But now on the book side, these items, so we have EFT sales, so that's money I'm getting, so we add that, and then the bank paid us interest, so we're getting that money, so we add that amount. My EFT payment, that's money going out of my account, okay? And I haven't made a journal entry for this yet, so I'll need to adjust for that, minus that on my EFT payment. It's money going out. And then a service charge. So the bank is charging us a fee. That's money going out. Okay. So these things are items that I hadn't already made journal entries for. Once I've completed my bank reconciliation, as you see here, my totals now equal. I now want to go ahead and make the journal entries for the adjustments I put on the book side. So I'll come down here, and I've prepared my journal entries already for each one of those items. So we have debit and credit. Let me add my borders. Alright, so the first item we had was an EFT sale. So we're getting money. So we have cash. Cash is our asset. It's increasing. It's going up. So we're going to debit our cash. Okay. And then we have accounts receivable. So we thought this person owed us money, but they paid us the money. So my accounts receivable is now going down. Interest. Okay, so I'll have interest revenue. Revenue will be going up. So we'll credit that. And cash is also, again, going up. So we'll debit that. Okay. Again, just a little reminder in case you need it. So we'll have assets plus expenses equals my liabilities plus owner's equity plus revenue. So if I want assets or expenses to get bigger, those will go on the left side. We'll debit those. If I want liabilities, owner's equity, or a revenue account to get bigger, we'll put those on the right side. So here I wanted my interest revenue to get bigger, so I put it on the right side to make that amount larger. EFT payment, so we have some expense of some X item, and whatever our expense was, we'll need to classify that. And my expense account is getting larger for that expense, so we'll debit that. And my cash is now getting smaller. Credit that. Service charge, my last item, my last journal entry I now need to make. We have an expense for the bank, so that's getting larger, my expense account, and then cash again getting smaller. Okay. The last thing we're going to look at today is for Chapter 7 we have Learning Objective 9, a petty cash fund. So a petty cash fund is cash on hand, a small amount of cash on hand that your business might have for kind of surprises that you might incur, or just have a little safety cash. Maybe you have drivers for your business, and drivers will need some money for gas, or maybe you'll have a little cash on the side if you want to have, you know, pizza Friday for your employees. Okay? If you go to the pizza company and order some pizza for your employees, they want to get paid cash. They won't bill you an invoice typically and wait for payment 30 days. So, or if we run out of supplies, you'll go down to your office supply store, and they'll want to get paid at the cash register before you walk out of the store with the supplies. Okay. So here we have maybe you just needed a little bit of emergency supplies. So we have petty cash is great for these instances. Okay. When you have a petty cash, you'll keep the money in a box. Only one person should have access to that box. The money should be locked away, protected. And then when you withdraw money from your cash drawer, your petty cash drawer or box, you should have the person sign out for how much money they're taking out and why they're taking money out, and date it. Okay. So here we are setting up our petty cash fund. So my petty cash is increasing and my cash in the bank decreasing. So I took money out of my bank to keep in this box or this drawer for special emergency type situations. Okay. And then when I use money from this small little fund that we have at our office, we will then say what was it used for and the amount, and then we'll need to decrease our petty cash fund. Okay. So we went ahead and we bought 90 worth of supplies. So my supplies account increases and my petty cash will decrease 90, so I'll have 10 remaining. Okay. We talk more in class about the safety protocols for internal controls and how to properly make sure that we manage our petty cash fund so that no one's taking money or abusing the petty cash fund at our company. That's it for today's lesson. I'll see you in class.